More and more, we're hearing that stocks are in overbought territory. But as one trader pointed out, we've had the S&P in overbought territory for 3 years between 1995 to 1998. Would you say that any pause we see right now is just a pause, especially given a lot of money sloshing around waiting to be put to use?
Good morning. Yes, I think that actually sums it up quite nicely. We've clearly had a tremendous run-up in stocks and in the U.S. in particular, and it's hard to argue that they don't look pretty fully valued and maybe on some measures overbought. But at the same time, there are plenty of other indicators, and particularly position indicators, that just show us how many investors have not participated in this rally. It's not been a popular rally. So to us, it seems like there's a lot of money that can still be put to work, that is still going to get sucked in, if you want to phrase it slightly less positively. And you know what? One of the drivers of this is while we've seen a massive rally in prices, volatility has actually stayed stubbornly high. So many institutional players and systematic players just have not been able to re-risk their portfolios. So all of those could still come back in.
When you take a look at the markets, the rally per se, it is suggesting a V-shaped recovery in the economy. When do you see eco data coming in line with what the market's suggesting? Because if you take a look at, for instance, Korea's unemployment just this morning, it's at the highest in 10 years. We saw data out of China also lagging expectations.
So I think it's actually a little bit ironic. We just got the official pronouncement in the U.S. that the cycle ended in February. So recession started in February, March time, and at the same time we've been saying for a few weeks, the recession is just about over. So we probably will have had the shortest recession or U.S. recession of all time. And I think it's very important to bear in mind how markets behave. I don't actually think that you need to assume a fully V-shaped recovery to the levels that we had before the virus to explain where the market is today. Markets look forward. Markets look at the rate of change. And, while the actual situation is still pretty dire, no other way of putting it, things are getting better. The recession is basically probably over here as virus restrictions come off. So, we don't think the economy is getting back to where it was until probably 2022. But we also don't think that means that markets necessarily are headed south. I think the two are not inconsistent.
And Patrik, you seem to be in the camp that perhaps this whole rotation has a bit of legs ahead of it. But we've seen markets go from recession to euphoria in just a matter of weeks. And yes, things are looking too lofty. But are there parts of the market you say, yes, we can still keep going, but other parts that are looking a little bit too vulnerable for you, and maybe it's time to tap out?
And I think that's a very, very important point. But first of all, let me say, yes, there are certainly some indicators that point to euphoria by investors. If you look at things like the options market in particular, but there are plenty of others that don't look, they've recovered a lot, but they don't look quite in euphoria territory yet. But I think you're quite right to point out that, not everything's rallied in the same way. We all know the story about the U.S. tech sector, the big six stocks there that are actually up on the year. But there are plenty of areas, particularly the cyclical areas in the markets that, have not rallied as much. They have started to rally over the last few weeks. And, we were expecting that to happen at some point. Again, it's happening much faster than you would normally expect. But everything has been, everything is on fast forward in this market cycle. But we do think the rotation into the more cyclical areas, out of your safe haven and techie growth plays, we think that has some room to run. It won't run forever, but it has some room here. That, by the way, does not mean that those other safe areas that had the lead until now necessarily have to fall. we think they probably just underperform. It doesn't mean they actually go down. But, that can carry the market for a while. And we almost think it's required for the market to move higher.
And Patrik, is the Fed going to do anything to keep the market going higher? It seems like we had a pretty stellar U.S. jobs report. We have economies reopening right now. Is it time for the Fed to actually start thinking of withdrawing some of its emergency support, or is more still needed?
I think it'd be quite dangerous for them to get into that game already. That discussion will undoubtedly arise. I think it's too early to go there. And, one of the near-term risks to the market, we don't ascribe a huge probability to it, but there certainly is a risk that we could get a mini taper tantrum where bond yields shoot higher because the Fed is rolling back, or, with all the government bond issuance that's going to come from all the fiscal spending that we've got around the world. So if the Fed loses control of this, bond yield spike, that certainly wouldn't be appreciated by equities or risk assets in general. That would mean tightening financial conditions, and that might snuff out the economic recovery. So I think the Fed will tread very, very carefully here. And, while they might not actually do anything at this meeting, I think they will talk very dovishly as much as they can.
Will they mention anything about yield curve control? I mean, our question of the day that we're asking our viewers is, if we do see some type of yield curve control, what part of the market does it help the most?
We think it's, again, probably a little bit early for them to get into that. It's entirely possible that we get there later in the year. And we would think they would go into clarifying the forward guidance before they get into outright yield curve control if it's needed. I think he's not saying anything hugely controversial here, that it's the longer end that it's at risk of running away. And there's a bit of controversy around here because we were talking about cyclical rotation. There's clearly a lot of interest out there in the value trade as well. And, one of the indicators that people have traditionally looked at is the steepness of the yield curve, which is exactly what we're talking about with yield curve control. And there's really a question, well, if the Fed keeps yields from rising, what does that actually mean for the value trade? Because really the yield curve is just an indicator of growth expectations. So, the Fed may be suppressing that, but it may not mean that much. So there's an active debate around that. But there's certainly, if you think about the more quantitative side of the market, there might be, quant players that get held back from that trade if it were to happen. But honestly, it's a debate for later in the year.